Hello everyone. Welcome back to Uncommon Sensibilities. Today is Market Update Day, June 1st, 2019. I'm going to start the month off with a little update. I'm going to break down for you what I see in the markets right now, what I'm watching in terms of indicators, and really the big threats or potential risks that I see around the corner. That and so much more coming right up. All right, so market update. Let's boil it down to the brass tacks here and let's talk about what's going on. Globally, economics are sound. They're good. Not great, not terrible. They were great. They softened a little bit. The markets care not about the status of things, be it economic matters, be it sales figures, be it housing market, be it whatever. Okay, the market cares about whether things are getting worse or getting better. So if things are good, they were great. You had to get from great to good somehow. That means you had to get a little bit worse. We've seen markets that have kind of reflected that. What I want to suggest though is domestically. In the United States, I'm a firm believer we remain in a constructive position with large cap stocks. I'm favorable on growth, but I'm beginning to put a significant amount of interest in watching the value-oriented positions to better hedge as we get into what I feel to be one of the largest headwinds in front of us, the U.S. election that's coming in 2020. So large cap stocks in the U.S. are good. We have a prevailing trend that is positive there. There is a stronger presence of buyer than seller, although sellers have surfaced recently. They're not quite strong enough yet to play the game of tug of war and pull the flag over the line to where I consider that to be a sell position. Mid and small cap, never did they gain enough not only momentum, but strength to render a green light. And that's coming out of the October to December of 2018 sell-off, leading into the full corrections and more that we found in the markets. They have surged in the early part of the year. They've softened since. And I genuinely feel as though those two types of positions should, if they are already in your portfolio, mid-cap, small-cap US, keep them in there. The only suggestion I would have is consider shifting from, if you're in a traditional type of investment, something that's maybe it's an index fund of mid-cap, maybe it's or small-cap, whatever it may be. Maybe consider shifting into something that focuses or targets more of a lower volatility exposure. Positions that are, not so subjected to the rigmarole, up and down chaos that can come with a marketplace with higher volatility. International and emerging markets, both international developed and emerging markets, I still remain not so much negative as I'm not interested in them right now. They have a probability, maybe I should dial that back. They have a possibility of gaining significant momentum going into the latter half of this year. We may even see that there is a shift in, if I were just to compare U.S. stocks versus international developed stocks, we might see that international developed stocks are able to gain enough strength that they become the better of the two in a head-to-head comparison. The reason I'm saying I'm not interested right now is there's still enough reason for significant uncertainty in the international markets. There was just an important election that gave us an idea that while the dominant parties are still favored, some of the more extreme parties are getting more attention. We're seeing concerns out of England with Theresa May stepping down. We're seeing concerns out of Germany with Angela Merkel potentially not having the successorship that she thought she did. All this equates to is uncertainty. Markets hate uncertainty. Don't go and put your neck on a guillotine because you think it looks like a good place to lay down look up and realize there's a blade hanging there. Granted, yes, there might be a rope attached to it, but do you really want to lay down there when there is a blade? Let's see if we can find instead a park bench that doesn't have a blade above you, right? That's just the way I'm looking at it right now. Until we see some of this uncertainty smooth over, until we see that there's a little bit more of a definitive course of probability for the greater developed Europe, which is a dominant representative in the developed international space, I would say hang tight there. If you want to add money on the fixed income side, you might consider, right now, if it's taxable money, consider municipal bonds. Until we see defined weakness in our economic data, until we see job cuts, until we see rate cuts from the Fed, until we see GDP slumping, until we see some of these very significant pieces of evidence that our economic well-being is questioned, municipal bonds provide a good tax-free income source, and municipalities have a high propensity for payback. They have a lower tendency to default when economic conditions are good, and that's because people pay taxes. Taxes are used to pay back the bonds. People are in a good position. Cities are in a good position. Developers, there's all kinds of things that are happening when economic conditions are good. Munis can be good. If you're in the IRA space, maybe it's a 401k or something like that, consider using general income type funds. I suggest using mutual funds when possible. Consider using somebody that has a total income type of portfolio, but be aware of how much equity they own. They might be a income bond fund, and then you go and you actually look at what they own and they've got 50% stocks. Okay, be aware of that. Take the time to look. Stay short on the maturity scale if you can. Stick with things that have low duration and low maturity numbers. I'm talking less than 2 years. Right now, again, uncertainty reigns supreme in the fixed income space as much as it does in any other space. So consider that. I'm watching 3 things right now in the equity world to give me a decent understanding of what trajectory we're going to follow in real time as we go on. I'm not going to try to prognosticate or predict the future. I can't do it. Never will I try to. Back in January, February, I suggested markets are going to be pretty strong leading up the first half of the year, give or take. But once Easter hits, there's a high probability we're going to see some softening. It just so happens May 3rd, 4th, 5th, we got the news on the China deal kind of going sour. I didn't predict the China deal going sour. I didn't predict any of that. But that would suggest that the markets soften because of one thing. That's not how it works. It never is just one thing. I was looking at all of the other things that are likely to begin converging right about the beginning of May, at the end of April, Easter time, and I had the belief that chances are we would probably reach a point of softening. We did. Okay, good. But going forward, looking at where we're headed, I'm going to watch 3 things. First, I'm going to be keeping a very close eye on 2 investments, crude oil and Bitcoin. I'm not suggesting invest in Bitcoin. That is not something that you should look at as an investment. That is a speculative trade for somebody who wants to go play that game. Go to Vegas and play Vegas gambling games. Go buy Bitcoin, any of the other cryptocurrencies. But what I will say is that Bitcoin and the greater cryptocurrency space, since its insane surge in 2000 and let's see here, that would have been 2017, mainly 2018, that immense run up in kind of fever pitch bubble type interest that ended up collapsing and popping, sort of sat quietly, but there's been a new resurgence in interest there. That is significant because I look at the cryptocurrency world as a good pulse for sentiment towards government and central banks. When Bitcoin and the cryptocurrency realm is doing very well, and this isn't driven these days, this is not driven just by random Joes around the world. There are large institutions that have very significant vested interests in the cryptocurrency world. But when that particular asset group or tool or utility gains strength, momentum, and interest, that's an indication that there is a growing mistrust or distrust in both government and central banking. So that's an indicator that I want to watch, because if I continue to see that going up, that's going to translate to me into a greater amount of uncertainty insofar as the US election that's coming in 2020. Okay, so part 2 of those two things, cryptocurrency, Bitcoin, and the amount of interest. That's interest can be measured in both the volatility of the given investment or the given, again, tool, utility, thing, but also, price appreciation. That would just simply mean that there's a higher number of buyers, a more interested buyership there. That translates to mistrust, distrust in government, mistrust, distrust in central banking, more uncertainty, markets hate uncertainty. Okay, that's connecting the dots. Part 2 here is oil. When I'm watching the oil marketplace, really what I'm watching with regards to that is if oil continues to struggle, okay, that to me is going to be an indication that either A, there's a higher level of manipulation in oil pricing, OPEC cutting production, or doing other types of manipulative measures. But when I'm watching that oil marketplace, if I continue to see oil struggling, okay, so if Bitcoin's going up, oil's struggling, those are two things that I'm going to say, okay, I'm keeping my ears really perked up. I'm really watching out for indications that are more direct in the domestic large cap stock marketplace. If things start to soften, I'm really going to be concerned. If things soften on the domestic stock marketplace, but oil is going up and Bitcoin's going down, I'm going to be a little bit less concerned with the status of things. I'm going to see it much more as maybe just a cooling off or a correction. So if I can kind of lump together oil and Bitcoin sort of as one kind of indicator, indicator number 2 is interest in long-term Treasury bonds. We saw a recent spike in those. We were seeing yields collapsing on the 10-year Treasury bond. That still holds to me as long-term for at least the individual investor. 10 years is a long time for the average person. Most people don't hold a single position in their portfolio for 10 years. If I continue to see a increase in interest in this space, that's going to coincide nicely with those two previous indicators, or those kind of bunched indicators there, that chances are there is a flight to safety. Whether it's justifiable safety or not doesn't matter. Point being, there is softening in the equity space. I keep an eye on just the long-term bond space right now. I don't care about inverted yield curves. You're going to hear all kinds of noise about that in your news. Right now, let it go. I'll cover that one in a separate video as to why that probably isn't what it used to be. Point number 3 is going to be really the election, the campaign. Right now, the number of players representing the Democratic ticket is not only unbelievably diverse, but it is also so broad. If I see that the field of players remains broad, I'm going to be setting myself up for a pretty rocky 2020. Now, sooner than that, here we are in June. This is one of those I'm not going to be able to watch real closely, because the field's probably going to stay broad, at least until we get into convention time, at least until we get into, when the average person starts paying a little bit more attention to what's going on. But I think that it's important to bear in mind that that is going to be an indication of overall sentiment that the market has towards its own future, is if we see a broad field of wildly different characters in the Democratic ticket, we should be very concerned about what markets will see in terms of uncertainty. All right, let's close this thing up. Markets as a whole, good. Not great, not terrible, good. Highly sensitive to volatility type positions that are going to swing. If the markets as a whole are swinging violently, be aware of those. If you can stomach it, hang in there. If you've got a 5 and 10 year time horizon on your investments, forget about those and just don't look at them. Stay the heck away from them. Don't let your psychological hindrances get in the way of you having successful long-term investments. Mid and small caps do well over long periods of time. Let them go. Okay? They may not be the best, but it's good to have them in the portfolio if you already have them. Don't go adding money there, though. Don't add money to really anything other than large cap US stock if you insist on adding money. Okay? And that's on the equity side. If you want to add money on the fixed income side, stay short on the maturity scale if you can. Stick with things that have low duration and low maturity numbers. I'm talking less than 2 years. 3 big indicators. The combination of crude oil plus Bitcoin. If crude's going down and Bitcoin is going up, I'm going to be concerned about the market. I'm going to be looking to start selling out of positions, even if I don't have any definitive change in leadership, and so far as a defined buyer strength over seller strength for my domestic stock. If I see those two continuing into late June, I'm going to start easing up on my equity exposure. Consider part number 2 being the long-term treasuries. If you see that the demand there remains strong, the buyership is the dominant player in the field there, and if you end up seeing the yields collapsing because of that, there's a pretty decent indication that there's a flight for safety. That might be enough sentiment to make a shift. It may be just enough to, in fact, suggest to the Fed that they cut rates. If they do that, in a rising rate environment, after the Fed cuts, historically, recessions come within 2 years. Probability would state that recessions come within 2 years. Whether or not that happens, whether or not there's enough statistical data to reflect that, the fact is people think that. They think rising rate environment, first cut, there's going to be a recession, so that will change the sentiment of the markets. If the Fed cuts rates, sentiment will shift drastically. So if long-term bonds are being purchased significantly, specifically Treasury bonds, and the Fed chooses to cut rates because they see that as a negative indication, okay, that's going to just compound the issue. So be aware of that. And then part 3, keep an eye on the election landscape. The more diverse, the more broad, the more uncertainty. Markets hate uncertainty. So that's how I want to prepare you to lead into the summer. Otherwise, stay aware, stay vigilant, consider what's going on, but don't let the sensationalized news, which I would call noise, get to you. Don't let it make you think otherwise. If you're not seeing those big indicators hitting, the rest is just a bunch of people on your TV blabbing to you things that are going to keep your attention long enough to get through the next commercial, because at the end of the day, they're making money off of you. Don't let them convince you of something that's not real. It's a monster in your closet. It's really not there. Stick with common sense. We're going to bring it back. Thanks so much for joining me. I'll talk to you soon. Hey everybody, thank you so much for joining me today. I hope today's video was helpful. I hope it was insightful for you. Perhaps I brought up a couple of ideas, thoughts, topics that you hadn't really thought about in terms of what the summer months might hold for us, what the election cycle may bring in terms of investor uncertainty, and ultimately some of these things that I'm watching closely may be something that you want to watch a little closer. If you're new to the channel, if this is your first time seeing any of the Uncommon Sensibilities videos, welcome. Thank you so much for joining me today. If you get the chance, click the subscribe button. I'd love to have you as a subscriber. I try to put out great videos talking about not only markets, but some of these larger economic issues that seem to be passed by in the mainstream media, or they're spun in such a way that they're just simply trying to persuade you of something rather than give you quality information. I want to distill down all the noise into viable news that you can use to better improve not only your outlook on the world, the economies of the world, the domestic U.S. economy, but help you better understand why things might be occurring in your portfolio the way they are, what it is that you can be doing to better suit your portfolio for your specific needs, your timeline, the things that you're looking for, because there's not a one-size-fits-all in the portfolio world. We need to be a little bit more cognizant of that, and we need to plan around our specific timelines and adjust our approach to the markets accordingly. That being said, if you're a recurring visitor, if you've been here before, thank you so much for coming back. It's awesome to have you. I love the idea that you're able to take some value from what I'm doing, at least enough so that you'll come back for more. I hope that I can continue doing that for you. And if anybody does, in fact, like today's video, please click the like button down below. Helps me out a ton. And if you don't like it, put a comment in the comment section. Let me know what you'd like to see improved. Thank you so much. Have a very happy, enjoyable summer. If you're going on vacation, travel safe, and we'll be back pretty soon here with part 2 in the 3-part China series. Thanks again for joining me. I look forward to seeing you again soon. Have a great one.